Certainty in markets is a dangerous illusion. We build models, trust experts, and believe we can predict the future. But the evidence says otherwise. Today, we dissect the psychology and mathematics of uncertainty, and why embracing it is the only rational path. Human brains are wired to see patterns, even where none exist. Kahneman's research shows we replace uncertainty with stories, models, and formulas. In markets, this manifests as quantitative risk parameters, fundamental analysis, historical backtests, and expert forecasts. Each gives us a false sense of control, but they all share a fatal flaw: they assume the future will resemble the past. For example, a trader might notice that a stock has risen after a certain chart pattern, and then assume it will always do so, ignoring the randomness of market movements. This pattern-seeking behavior is a survival mechanism that served our ancestors well in a simpler world, but in the complex, dynamic environment of financial markets, it leads to systematic errors. We overestimate the reliability of our models and underestimate the role of chance, setting ourselves up for surprises that can be financially devastating. Let's formalize the problem. In probability theory, the expected value of an investment is the sum of each possible outcome multiplied by its probability. But we never know the true probabilities. We estimate them from historical data, assuming stationarity, that the process doesn't change. This assumption is almost always wrong. For instance, consider a stock that has historically returned 8% annually with a standard deviation of 15%. We might use these numbers to calculate the probability of a loss in any given year. However, if the market regime shifts, say, due to a technological disruption or a change in monetary policy, the actual distribution of returns can change dramatically, making our estimates obsolete. The mathematical elegance of probability theory gives us a false sense of precision, but the inputs are often garbage, leading to outputs that are not just imprecise but dangerously misleading. Kahneman identified two systems of thinking. System 1 is fast, intuitive, and prone to biases. System 2 is slow, deliberate, but lazy. In markets, we rely on System 1 to make quick judgments, but it leads to overconfidence, anchoring, and confirmation bias. We see patterns in noise and believe we understand what we don't. For example, after a stock has risen for several days, we might anchor on that recent performance and expect it to continue, ignoring the fundamental value. Or we might only seek out information that confirms our existing beliefs about a stock, disregarding contradictory evidence. These cognitive traps cause us to misjudge probabilities and take on excessive risk. Even professional investors are not immune; they often fall prey to the same biases, leading to herding behavior and market bubbles. Recognizing these biases is the first step to mitigating their impact on our investment decisions. Taleb's black swan events are outliers that have massive impact and are easily explained after the fact. Mathematically, they reside in the tails of a distribution. In a normal distribution, the probability of a 10 sigma event is virtually zero. But real markets have fat tails, where such events are far more likely. This is why models based on normal distributions fail. For instance, the 2008 financial crisis was a black swan that many quantitative models deemed nearly impossible, yet it happened and caused global turmoil. The assumption of normality underestimates the likelihood of extreme events, leading to inadequate risk management. By acknowledging fat tails, we can better prepare for rare but consequential occurrences. This does not mean we can predict them, but we can build portfolios that are resilient to their impact, rather than being caught off guard by their occurrence. History is littered with black swans. World War I, the collapse of the Soviet Union, 9/11, the 2008 financial crisis, and COVID-19, none were predicted by mainstream models. Each event reshaped the world and markets, yet forecasters were caught off guard. The lesson is clear: our predictive tools are not just imperfect, they are fundamentally blind to the most consequential events. For example, before 2008, many economists believed that housing prices would never fall on a national scale, and their models reflected this assumption. When the crisis hit, it exposed the fragility of the financial system and the failure of risk management. These events are not anomalies but rather a recurring feature of complex systems. By studying them, we can learn to expect the unexpected and design our strategies to be robust to a wide range of outcomes, rather than relying on precise predictions that are bound to fail. The traditional approach is to predict and protect. But prediction fails. The alternative is antifragility, building systems that gain from disorder. Instead of trying to forecast the next crisis, we can structure portfolios to benefit from volatility. This is a fundamental shift in mindset. For example, an antifragile portfolio might include a mix of assets that perform well in different scenarios, such as gold during inflation, government bonds during deflation, and options that pay off when markets crash. By embracing volatility, we can turn uncertainty into an advantage. This does not mean taking on reckless risk, but rather designing a portfolio that is resilient and can even thrive when the unexpected occurs. The concept of antifragility, popularized by Taleb, encourages us to focus on building systems that are robust to errors and can capitalize on the unpredictable nature of markets. One practical application is the Kelly Criterion, which tells you how much to bet when you have an edge. It maximizes long-term growth while avoiding ruin. The formula is F*= BP, Q/B, where B is the odds, P is the probability of winning, and Q is the probability of losing. But note, it requires accurate probabilities, which we often don't have. So we must be conservative. For instance, if you have a 60% chance of winning a bet with even odds, the Kelly Criterion suggests betting 20% of your bankroll. However, if your probability estimate is off by even a small margin, the optimal bet size can change dramatically, and overbetting can lead to ruin. Therefore, in practice, investors often use fractional Kelly, betting only a fraction of the recommended amount to account for estimation error. This approach balances growth with safety, acknowledging that our probabilities are never perfect. Experts are not better at predicting than the average person. Studies by Tedlock and others show that expert forecasts are barely more accurate than chance. The problem is that experts are rewarded for confidence, not accuracy. They build narratives that sound plausible but have no predictive power. In markets, this leads to overconfidence and excessive risk-taking. For example, a well-known economist might predict a recession with great certainty, but if the prediction is wrong, they are rarely held accountable. Instead, they are praised for their boldness. This incentive structure encourages experts to make bold, confident predictions, even when they have no real insight. As a result, investors who follow these forecasts are often misled. Recognizing the limitations of expert opinion is crucial for making rational investment decisions. Rather than relying on forecasts, we should focus on building robust portfolios that can withstand a variety of outcomes. We crave control, so we create models that give us a sense of mastery. But the more complex the model, the more fragile it becomes. In 2008, complex mortgage-backed securities were rated safe by models that ignored tail risks. When the housing market turned, the entire system collapsed. The illusion of control was the root cause. For example, these models assumed that housing prices would continue to rise and that defaults would be low, based on historical data. They did not account for the possibility of a nationwide decline in housing prices, which was considered extremely unlikely. When that scenario materialized, the models failed catastrophically, leading to massive losses. This illustrates that our desire for control can blind us to the limitations of our models. By acknowledging that we cannot control or predict every outcome, we can take steps to protect ourselves, such as diversifying and avoiding excessive leverage. So what do? We embrace uncertainty. We diversify across truly uncorrelated assets, we hold cash to take advantage of crashes, and we use options to profit from volatility. We avoid leverage and stress test our portfolios against extreme scenarios. The goal is not to predict the future, but to be prepared for any future. For instance, a portfolio that includes stocks, bonds, gold, and cash can weather different economic conditions. Holding cash allows you to buy assets at depressed prices during market crashes. Options, such as put options, can provide insurance against market downturns and even generate profits if volatility spikes. By avoiding leverage, we reduce the risk of forced selling during downturns. Stress testing our portfolios against scenarios like a 50% market drop or a sudden interest rate hike helps us identify vulnerabilities and adjust our positions accordingly. This approach prioritizes resilience over prediction, ensuring that we can survive and even thrive in an uncertain world. The illusion of certainty is the greatest risk in finance. By acknowledging that we cannot predict the future, we can build systems that survive and even thrive in uncertainty. This is not surrender, it is the only rational strategy. We'd love to hear your perspective. In summary, we have explored the psychological and mathematical reasons why market certainty is an illusion. We have seen how our brains are wired to find patterns, how our models are based on flawed assumptions, and how even experts are often wrong. By embracing uncertainty and building antifragile portfolios, we can turn the unpredictability of markets into an advantage. The key is to focus on preparation rather than prediction, and to remain humble in the face of the unknown. Thank you for watching, and we look forward to your comments. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.